4 things you must know if you're retiring with a pension. It's time to talk about a unique and incredibly valuable aspect of retirement planning, your pension. In this discussion, we're going to dive deep into 4 absolutely essential strategies that every individual fortunate enough to hold a pension must understand. These strategies are crucial not just for protecting your hard-earned income, but also for ensuring you avoid unnecessary taxation and ultimately extract the maximum benefit from your pension throughout your retirement years. The reason this topic is so critical is that retirement planning with a pension in hand is fundamentally different from navigating retirement without one. As of 2024, the landscape of retirement benefits has shifted significantly. Only about 24% of working Americans actually have access to a traditional pension plan, and a substantial portion of these individuals are employed in the government sector. If you are one of these fortunate few, it means your personal financial situation is already distinctive. This uniqueness implies that your approach to retirement planning must be tailored. It cannot be a one-size-fits-all strategy. In contrast to the majority of the population who might primarily rely on Social Security as their sole source of guaranteed fixed income, you possess a powerful second stream, a consistent monthly pension income. This second source fundamentally transforms the entire game of retirement planning, opening up different possibilities and requiring distinct considerations. So, how exactly does having a pension alter your retirement trajectory? Let's explore. Understanding your pension type and formula. The very first step, and arguably the most crucial, is to gain a crystal clear understanding of the specific type of pension you have. Are you enrolled in a defined benefit plan which promises guaranteed monthly payments for the rest of your life, offering unparalleled income predictability? Or do you have a cash balance plan which often presents the option of a lump sum payout that you receive as a one-time distribution, giving you the freedom to invest it yourself? This seemingly minor detail is incredibly significant, as it directly impacts the predictability of your future income and the level of investment risk you will personally bear. For the purpose of this discussion, we will be focusing on the more traditional defined benefit plan, where you typically do not have the choice of a lump sum payout that you could roll over into another investment vehicle. Instead, your benefit will arrive as a consistent monthly income. Given that it's a monthly income stream, it is imperative that you fully comprehend your pension's specific formula. Your journey to understanding this should begin with a simple yet vital conversation with your HR department. Ask them directly about the formula they use to calculate your benefits. Most pension plans utilize a variation of a common structure: your years of dedicated service multiplied by a specific percentage, often referred to as a multiplier, and then multiplied again by your final average salary. For instance, consider an example: 30 years of dedicated service multiplied by a 2% factor and then multiplied by a final average salary of $80,000 would result in an annual pension of $48,000 for the remainder of your life. However, the formula's intricacies don't end there. Another critical component to investigate is whether your pension includes an inflation enhancer. Many traditional pension plans, unfortunately, do not incorporate any mechanism to adjust for inflation. What this means in our example is that the $48,000 you receive each year will remain exactly $48,000 year after year for your entire retirement. While some pensions do offer a modest inflation enhancer, perhaps 1% or 2% per year, it is exceedingly rare, and I truly mean rarely, that these increases keep pace with the actual rate of inflation over the span of a long retirement. So, what are the practical implications of this reality? It means that while you possess an incredibly valuable and dependable fixed income source in retirement, its purchasing power is highly likely to diminish over time. If future inflation rates are, for example, 3%, 4%, 5%, or even higher, that fixed income will gradually become less and less valuable. It will be able to purchase fewer goods and services, inevitably impacting your standard of living and financial comfort in your later years. Therefore, it is absolutely essential to gain clarity on your pension's current worth and precisely what it is projected to be at your target retirement age. This foundational understanding is the bedrock upon which you can strategically decide when to begin taking your pension, how to best protect its value, and how it seamlessly integrates into your broader, holistic retirement plan. Navigating the tax landscape of your pension. Now for a topic that is perhaps less fun but equally critical: taxes. Your pension income is typically taxed as ordinary income. This can have significant repercussions, potentially pushing you into higher tax brackets during retirement. Being in a higher tax bracket can, in turn, make a larger portion of your Social Security benefits taxable and can even lead to increased Medicare premiums, known as income-related monthly adjustment amounts, RMAA. It's a common refrain in financial media that you'll likely find yourself in a lower tax bracket in retirement than you were during your working years. On the surface, this might seem logical. After all, you're no longer earning a salary. However, in practice, this is often not the case. In fact, based on my 25 years of experience working closely with retirees, I've observed that the vast majority of individuals I assist, after the initial few years of early retirement, find themselves in the same or even higher tax brackets than they were while working. And here's the kicker: if you have a pension, this scenario becomes even more probable. Successfully managing your retirement finances with a pension requires intricate coordination. You need to align your pension strategy with your Social Security claiming strategy, your withdrawal plans from any other retirement accounts, any income you might receive from annuities or rental properties, and, crucially, your required minimum distributions, RMDs, once you reach the specified age. It's worth noting that there's a temporary tax deduction available for individuals 65 or older, sometimes called the senior bonus, amounting to $6,000 per person, which can offer some relief. Despite this, Social Security benefits remain taxable for single filers with provisional income exceeding $34,000 and for joint filers with provisional income above $44,000. Up to 85% of your Social Security benefits could be subject to taxation. It is highly probable that someone receiving a pension, Social Security, and making even modest withdrawals from their retirement accounts will indeed find themselves in a similar tax bracket as they were before retirement. Furthermore, depending on future changes to the tax code, it is entirely possible that you could end up in an even higher bracket down the line. The highly discussed Big Beautiful Bill, while certainly controversial in many aspects, provided one crucial element for retirement planning that we can all appreciate. Whether you agree with the current tax rates or not, they are now considered permanent, offering a level of clarity and predictability for long-term planning. There's no sunset date for these rates, though, of course. A future Congress always retains the power to raise them. If you're interested in a concise summary of the critical tax planning components of that bill, we've created a free ebook available for download on my website, celestialwm.com, a BB ebook, and I'll include a link in the description for your convenience. To effectively prepare, you should begin now by modeling what your Social Security benefits will look like at your full retirement age and what your estimated pension benefit will be. This combined figure will establish your baseline income. Regardless of other factors, you will have taxable income at this level. From this baseline, you can project your future effective tax rate and determine whether you are likely to be hit with Medicare surcharges, also known as IRMAA. But remember, this calculation is before you even consider withdrawals from other retirement accounts or income from annuities or rental properties. A significant point of concern for many retirees is required minimum distributions, RMDs. Once you reach a certain age, currently 73, though it is scheduled to shift to 75 in the coming decade, you are legally mandated to start withdrawing money from your pre-tax retirement accounts, irrespective of whether you actually need the funds at that moment. This requirement often catches many off guard, particularly those who find they can comfortably live on their pension and Social Security alone. RMDs introduce another source of taxable income that they don't necessarily need for living expenses, thereby pushing them into successively higher tax brackets. For example, let's assume you've diligently accumulated a $500,000 pre-tax retirement account during your working years, in addition to your pension and Social Security. Based on the RMD life expectancy tables, at age 73, you would be required to withdraw $500,000 divided by 26.5, which equals approximately $18,168. This amount is additional income to you, it is mandatory, and it is 100% taxable. So, what proactive steps can you take to mitigate these potential tax burdens? First, as previously mentioned, you absolutely must gain a clear picture of what your future income streams will look like. Most advanced financial planning software can accurately model these scenarios. Second, and equally important, you need to thoroughly understand what a Roth conversion entails. A Roth conversion is a strategic maneuver where you transfer funds from your pre-tax retirement accounts, such as 401ks, 403bs, and traditional IRAs, into a tax-free Roth IRA. When you execute this transfer, the money becomes 100% taxable to you in the year the conversion takes place. However, and this is the crucial benefit, that money is never taxed again, not on its growth and not on any future distributions. This strategy is an important consideration for almost everyone, but it becomes even more vital if you are retiring with a pension. The reason for its heightened importance for pension holders is that your income in retirement is likely to be similar to or even higher than what it was while you were working. This means there's a strong probability you'll remain in the same or a higher tax bracket. In either of these scenarios, a Roth conversion is highly likely to be a beneficial move. The only time you might choose not to convert is if you are confident that you will be in a significantly lower tax bracket in retirement, a prospect that is highly improbable for the 24% of working Americans who possess a pension. Does the analysis of a Roth conversion stop there? Unfortunately, no. It's considerably more complex. When contemplating a conversion, you need to assess not only its impact on your current and future tax brackets, but also understand that the conversion income itself could trigger immediate IRMAA Medicare surcharges or subject you to the 3.8% net investment income tax, NIIT, which applies to singles earning over $200,000 and married couples earning over $250,000. While you may not typically earn anywhere near these thresholds, executing a large conversion in a single year could indeed expose you to several of these additional charges. Furthermore, that increased income could potentially phase you out of certain valuable tax deductions, such as the senior bonus. In such cases, a more prudent approach might be to spread out your Roth conversions strategically over a period of several years or even decades to manage the tax impact more effectively. I emphasize all these complexities because it is a profoundly intricate decision. It is absolutely paramount that you meticulously weigh all the pros and cons with both your tax and financial advisors before implementing any Roth conversion strategy. Simply hearing about it on YouTube, while informative, is not sufficient. You must run your own specific numbers to determine the optimal course of action for your unique financial situation. Remember, the forest through the trees is more than just a channel. It's a community dedicated to helping you make informed decisions. Consider becoming a private member for just $2.99 a month to gain access to perks like early video access. Simply click the join button to learn more. Choosing the right pension payout option. When the time comes to initiate your pension benefits, you will be presented with a critical decision: choosing your payout option. This decision should not be taken lightly and requires careful consideration of your personal circumstances and future needs. The single life option typically offers the highest monthly payment, providing the maximum income during your lifetime. However, this payment ceases entirely upon your death, leaving no continuing benefit for a surviving spouse. Conversely, the joint and survivor option is designed to continue payments to your spouse after your passing, but it comes with a trade-off, a lower monthly amount during your lifetime. A third option, sometimes available, is called period certain. This offers a payment amount somewhere between the single life and joint and survivor options for a specified period, perhaps 10 or 15 years. If you retire and then unfortunately pass away within the first year or two of retirement, the pension would continue paying for that entire designated period, ensuring a minimum benefit is distributed. Making the wrong choice here can have profound and lasting consequences. You could inadvertently leave your surviving spouse without sufficient income to maintain their standard of living, or you could end up taking a significantly reduced payment for decades when, in hindsight, it wasn't truly necessary. If you are single, the choice is generally straightforward. You would typically opt for the highest possible monthly amount. However, for a married couple, the decision becomes considerably more complex, intertwining financial security with emotional considerations. Key questions arise. If the spouse who holds the pension were to pass away, would the widowed spouse have enough income and assets to comfortably sustain themselves? What is the age difference between the spouses, as this can impact life expectancy projections? What does the family health history look like for both individuals? If there is a substantial age difference between spouses, or if one or both individuals have known health issues that could shorten life expectancy, then electing the joint and survivor benefit may make a lot more sense, prioritizing long-term security for the survivor. For other couples, particularly those in good health, a different strategy might be more advantageous, electing the higher single life benefit and using a portion of that increased income to purchase an affordable term life insurance policy. This policy could then provide a substantial lump sum to the surviving spouse, often offering a better alternative to the permanently reduced survivor option. Ultimately, the best choice depends entirely on your unique circumstances. A critical, often overlooked aspect to understand and plan for is what happens financially when one spouse passes away in retirement. When you are married, you benefit from several advantages, including a higher tax bracket threshold. This means you can earn substantially more income as a couple before being pushed into a higher tax bracket than a single individual. The same principle applies to Medicare IRMA surcharges, the NIIT tax, and various tax deduction phase-outs. Additionally, upon the death of a spouse, you typically lose one of your Social Security benefits, specifically the lower of the two. Many times, I observe what I refer to as the widow's penalty, where the surviving spouse not only loses a Social Security benefit, but also often finds themselves in a higher tax bracket with reduced tax deductions precisely when they need financial stability most. It is an unfortunate reality, but with diligent and proper planning, this penalty can be mitigated, if not entirely avoided. Therefore, it is essential to leverage the advantages of being married to optimize both your income streams and your tax liabilities throughout your retirement years. Integrating your pension into your investment strategy. Finally, let's discuss how your pension should influence your investment strategy. When you possess a pension, you effectively have one of the most powerful and dependable fixed income streams available. It is absolutely imperative that you integrate this significant asset directly into your overall investment strategy. Why? Because, as we explained earlier, that fixed income stream is often just that, fixed. Or if it does increase, it's typically by a very modest amount that may not keep pace with inflation. This unique characteristic means your investment strategy should be different from that of someone without a pension. Firstly, your other investments generally don't need to generate as much income to support your living expenses. A substantial portion of your baseline income is already secured by your pension. Secondly, you don't have to worry as intensely about a significant decline in your investment portfolio during the early years of retirement. This is because you may not need to withdraw much, if anything at all, from your investment accounts initially. This cushion allows you to ride out market volatility far more effectively and with less stress than the majority of other retirees who are drawing directly from their portfolios for income. This inherent stability grants you a remarkable amount of flexibility and peace of mind that many others simply do not have. Let's revisit the example from earlier in the video. Imagine you have a $48,000 annual pension. To put that into perspective, if you wanted to generate that exact same amount of income today solely from a relatively safe investment like a 10-year treasury bond with a current yield of, say, 4.29%, you would need an investment principal of approximately $1,118,881. This highlights the enormous capital value represented by your pension. When you're considering your overall investment allocation, it would be illogical, imprudent, and frankly irresponsible not to account for your pension as a foundational part of your total asset base. Having such a robust fixed income asset like a pension can empower you to strategically allocate a larger portion of your other investment assets towards growth-oriented investments, such as equities. This contrasts sharply with individuals who lack a pension, as they often need to prioritize stability and income generation within their investment portfolio to provide for their distributions. For you, the stability is already provided in the form of your guaranteed pension payments. As you can now clearly see, pensions are undoubtedly a powerful asset, but the decisions you make concerning them can profoundly impact your income, your tax liabilities, and your overall financial security for many decades to come. Ensure you truly understand the specifics of your plan. Strategically claim your benefits at the optimal time, carefully choose the most appropriate payout option, and thoroughly coordinate it with all your other income streams. When approached correctly and with diligent planning, your pension can serve as the unwavering backbone of a truly secure, comfortable, and prosperous retirement. If you're consistently finding immense value in these videos, please consider becoming a community member to support our work. And for even more ways to supercharge your net worth, make sure to check out the next video.